How do you think about accounting? Like any other business tool, it's used for a purpose, and you can and should shape it to your particular business purpose. Dr. David J. Rapp is here to explain how.
This is the Economics for Entrepreneurs podcast, a project of the Mises Institute, applying the principles of economics to start, grow, and manage your business. For free tools, resources, key takeaways, and actionable insights from each episode, visit Mises.org/E4EPod. Now, here's Hunter Hastings.
Hi, Hunter Hastings here. Today we're talking about accounting. Don't sign off. Erase from your mind any ideas that accounting is boring, dry, or a chore, or even dispensable. We're going to look at it from an Austrian perspective, which makes it dynamic, exciting, and above all, purposeful. Paul Tenney, a very successful international tech entrepreneur who was here a couple of weeks ago in episode 49, and whom we asked about critical success factors for entrepreneurs, told us to learn accounting. Along with knowing how to write good contracts, he said, it's one of the indispensable tools of business success. It's a tool in the sense of being a means to help you realize your business goals. Our guest today, David Rapp, emphasizes this. Think of accounting as a means, suggesting that you have options in the way that you use it. And different entrepreneurs will use it in different ways, in different circumstances, for different purposes. You need to follow the local rules for reporting, of course, but even within those rules, you have options. And your internal accounting, your economic calculation to support future decisions and actions, is even more malleable than your historical reporting. So in this very real sense, accounting accommodates Austrian notions of individualism, subjective value, and entrepreneurial judgment, and market dynamics. It can even help you to deal with uncertainty. Our guest today, Dr. David Rapp, is one of the world's leading experts in accounting, with a global perspective and uniquely Austrian insight. He teaches accounting and management control at a top French business school. Let me test my French here. The Institut Mines Télécom. It's near Paris. It's a peerless institution, what the French call a grande école, which is the top of the top. Dr. Rapp, welcome to Economics for Entrepreneurs.
Well, thanks for having me, Hunter. It's a great honor to appear on your podcast.
Well, you've given me permission to call you David, so we'll do that from now on. You're joining us from Europe, and we appreciate you doing that. In fact, we're excited to have your expertise available to us to talk about accounting from an Austrian perspective. And we'll look at it primarily from the viewpoint of the entrepreneur and the firm. Those are our listeners. And we start out with a point of view that economic calculation that's captured in accounting it's a precondition for all decisions that entrepreneurs make about production. Carl Menger called economic calculation one of the four pillars of entrepreneurship. So we're in an important place here. So we talk about accounting really in two frames, David, I think. The accounting of profit and loss, which is retrospective. We're looking back at what happened in the past. And what you've called economic or commercial pre-calculation, which is used in planning future action. So maybe the first one we can call financial accounting, and the second one managerial accounting. But let's start there. Let's ask you to explain each one of those for us, the retrospective and the prospective.
Well, sure. So if we start from a Misesian terminology, then yes, we can distinguish between capital accounting, which is also called accounting of profit and loss on the one hand, and cost accounting, or what he also calls commercial pre-calculation on the other hand. Well, they differ with regard to several characteristics. Fundamentally, they differ from the perspective of the main purpose of the calculation. So whereas capital accounting, or you're very right, Hunter, contemporarily financial accounting or financial reporting, seeks to reveal the success or failure, so the profit or loss of entrepreneurial activity. And it also aims at computing the consumption possibility without reducing a business's capital, which is called income. On the other hand, cost accounting or commercial pre-calculation, or if we want to use a contemporary term, managerial accounting, seeks to structure and plan for potential future action and shall serve as the basis for entrepreneurial judgment about whether or not particular path of future action are seen as worthwhile. And due to these different purposes, the temporal perspective of both differs also. Whereas financial accounting, of course, is primarily retrospective, it's primarily directed towards past action, but of course also has implications for future action. Managerial accounting is anticipatory in nature, so it is directed towards possible future paths of action. Whereas the main tools of financial accounting are usually balance sheets, income or profit and loss statements, maybe also statements of cash flow. Within managerial accounting, we find stuff like investment appraisal, costing, cost accounting for pricing decisions, and so on and so forth. Both spheres actually also differ with regard to their primary addressee. Whereas managerial accounting, and the term actually suggests it, has a primary addressee internal in the company. So it's for the entrepreneur or the manager, depending on what kind of firm we're talking about. Financial accounting or financial reporting is primarily addressed towards external users of financial statements. For example, actual or potential stakeholders or shareholders, actually, or the government, tax authorities, creditors, banks, and the like, who have an information need about the state of a company. In that sense, the contemporary notion of financial accounting differs a little bit from the Misesian capital accounting, because it seems that Mises primarily had in mind the entrepreneur, which kind of wanted to be self-informed by his capital accounting about the success or failure, profit or loss of his recent actions. So here's a little bit of a difference between the contemporary term financial accounting or reporting, because it's primarily addressed towards external users of information. And last, both spheres, financial accounting and managerial accounting, can be distinguished based on whether or not they are regulated, whereas financial reporting is regulated by either commercial law or accounting standards, such as the US GAAP, the United States Generally Accepted Accounting Principles, or IFRS, International Financial Reporting Standards. Managerial accounting largely gets along without any regulation, and it is up to the actual acting entrepreneur to decide for him or herself what means he wants to employ in planning future action.
Yeah, I work a little bit in venture capital, David, and when we look at very early stage businesses, you look back at the accounting and profit and loss, and the business will say, well, that's not relevant because we're in such a fast growth mode that the past doesn't mean much. And then they present you with a future appraisal of economic possibilities, and some of them are quite imaginative, and so they use them for purposes of advertising and promotion sometimes. So, well, I like that differentiation of looking back and looking forward, and thank you for being so thorough in that. You've also said, David, that we can look at the Austrian concept of accounting as a means to achieve desired ends. So the entrepreneur can employ these methods to attain his or her ends, which suggests that there's some options in applying accounting to the business. There's some entrepreneurial judgment that can be at work here. So can you tell us about that?
Well, indeed, I think that's exactly the way you should look at it. So, accounting can and should be interpreted as a specific means to attain ends. So, accounting is actually most helpful to the entrepreneur if it is employed, of course, respecting its legal limitations to support intended ends. And yes, making use of explicit or implicit options in applying accounting rules is actually in itself an entrepreneurial action, requiring judgment about the possible uncertain future effects of applying rules one way or another. If I may address both spheres of accounting, then I would say that as regards financial accounting, entrepreneurs should proactively and purposefully make use of options in the application of accounting rules. In general, it is important to note that purpose orientation is one of the most important principles in the field of accounting. One of the founding fathers of early German language business management theory and accounting theory in particular, who was Professor Eugen Schmalenbach, emphasized that any computation, be it for internal or external reasons, should be determined by its underlying purpose. Now, for instance, if a particular firm seeks to pay as little taxes as possible, or even no taxes at all, and their statements are relevant for taxation, then it may apply accounting rules, for instance, those concerning the depreciation or amortization of assets, in a way that actually reduces profit best possible. Vice versa, if you imagine a firm seeking external funding and thus wanting to present itself in the best possible way, it should apply the rules in a manner increasing profit and thus supporting this goal. Prototypical fields in which entrepreneurs may exercise judgment on how to apply accounting rules and thus to exercise what is usually called earnings management or balance sheet policy contain the depreciation of assets. If you think about property, plant, equipment, for example, then it's up to the entrepreneur to estimate the asset's useful life, which is uncertain. It's up to the entrepreneur to decide what depreciation method he wants to apply. For example, the straight line method or a diminishing balance method. And oftentimes you may have what is usually called a residual value of the asset at the end of its useful life, which of course is also uncertain because you need to estimate for what price may I sell this machine at the end of its useful life, which is highly uncertain. The same is true when we talk about inventory cost determination. So if you have particular inventory, then usually you don't know what exact part of the inventory, what exact item you bought at what price. So there are different valuation techniques to determine the cost of inventory for balance sheet purposes. For example, first in, first out, which assumes that the inventory bought first is actually the one that we sell first, even though this is not necessarily physically the case, or vice versa, the last in, first out approach or an average cost approach. Other areas where entrepreneurial judgment is required are, for example, provisions, where you basically have more or less liabilities, but with uncertain timing and or amount. So if somebody sues a business, well, then it might be that the business will be held liable, and it might be that the business needs to pay a certain compensation, but it's not certain if it has to do so, and if so, when. So there's also uncertainty and thus a requirement for entrepreneurial judgment. And fourth, maybe this is also true in case of fair value determination. So if accounting requires to measure particular assets at their fair value, then at least at different hierarchy stages of fair value determination, there's a huge there's huge degrees of freedom, huge implicit and explicit options for the entrepreneur to apply, which will then maybe have a significant impact on the outcome of the measurement of assets for balance sheet purposes. And well, this may impact actually the entire financial statements quite materially. If we regard internal considerations, so if we are within the sphere of managerial accounting, then the notion of purposeful action is as important as it is in financial accounting. If, for instance, an entrepreneur requires a transparent and sound basis for his judgment concerning a potential investment, well, then the corresponding computation must be in line with this purpose. Or, in other words, it must be based on sound Austrian principles of human action rather than considering an entirely hypothetical, pseudo-ideal and pseudo-objective world of static equilibrium as held by neoclassicism.
Dr. David Rapp is helping us with some very complex topics in this interview. You might be listening to it in the gym, or on your commute to or from work, or in the kitchen while cooking, or maybe even at the airport. Did you know we've condensed the important takeaways and talking points of this episode, just as we do for all of our episodes, into a simple PDF that you can download for free online? Head to e4epod.com/51 for the episode notes and downloadable resources for this episode. And while you're there, check out all of the downloads and tools that we've created for episodes past. That's the letter E, the number 4, the letter E, pod.com/51, the number 51. Now, back to the conversation with David. Well, let's dig into that a little bit more, David, because that's really interesting for our audience, that using accounting as a means to entrepreneurial ends, there are ways that you might adhere to sound Austrian principles of economics and ways that you might be more distorted by looking through a neoclassical lens. Can you go into that a little bit further for us, please?
Sure. So, well, yes, accounting is most supportive of entrepreneurial management if it adheres to sound principles of economics, so Austrian principles, basically. So in contrast, if it is based upon neoclassical ideology, as is actually the case both within dominant regimes of financial reporting and managerial accounting, it cannot be supportive, but will be misleading instead. And the simple reason is because neoclassicism fails to capture the specific circumstances and prerequisites of entrepreneurial action. If we focus, for instance, on fair value accounting, which basically requires to account for inter alia assets with their current market prices and is an integral part of both US GAAP and IFRS accounting, it builds upon a static neoclassical view of market equilibrium. And the same is true for mainstream models applied within managerial accounting, which are often based upon contemporary finance theory, which also springs from neoclassicism. Oftentimes, though, such recourse to neoclassicism causes logic errors. For example, the accounting regulation called IFRS, the International Financial Reporting Standards, primarily seek to reduce information asymmetries between the reporting company and current and future shareholders. However, within neoclassicism, information asymmetries cannot occur at all as they are excluded by assumption. And thus, one may wonder why and how accounting standards shall reduce information asymmetries if their underlying theory doesn't even allow for such differences in information in general. And the unrealistic and rigid assumptions related to neoclassicism are problematic for both financial and managerial accounting, simply because both types of accounting are to be conducted in the real world, and neoclassicism is fairly unrelated to the real world. If we talk about the internal computation, so the sphere of managerial accounting, then entrepreneurs risk to be misled if they naively follow the neoclassical mainstream as propagated by many academics, consultants, bankers, and others. For instance, modern finance theory and models springing from it, such as the capital asset pricing model or the weighted average cost of capital approach, are directly derived from the rigid and unrealistic framework of neoclassicism, and thus are doomed to failure when trying to support any real-world entrepreneur in his judgment on potential future action. Let me illustrate that with an example. If you just think about the popular saying, well, don't put all your eggs in one basket, right? Everybody knows this general guidance, and it is claimed to be of general validity and to be applicable to each and any case. However, few people know that it is derived from neoclassical portfolio theory and is as such only valid given certain assumptions, in particular risk aversion of the decision maker and a specific decision rule. Especially in light of what entrepreneurs, in particular those creating new ventures, usually do, that is to invest all funds available to them into their business, the before mentioned guidance seems fairly unsuited, I think. So if you put it in other words, entrepreneurs investing everything they have into their business, they act in direct opposition to what neoclassical portfolio theory holds, and hence seemingly irrationally. However, in reality, it would seem quite odd, I think, if the average entrepreneur tried to invest in a so called optimally diversified portfolio rather than concentrating on developing his or her business. Rather than relying on such neoclassicism, entrepreneurs should integrate sound Austrian principles into their accounting considerations. So while firms are usually legally required to apply particular financial accounting rules, no matter whether or not these rules are neoclassical and as such unsuitable in nature, insights from Austrian economics can particularly be smoothly integrated into managerial accounting. Entrepreneurs should, for instance, consider fundamental Austrian insights such as the subjectivity of value, the importance of opportunity costs, the insight that value and price are two different things and must hence be distinguished from one another, the distinction between uncertainty and risk and their respective implications, and not least the fact that prices determine costs rather than vice versa.
Help us a little bit more with some of those things, David. So how in a accounting, which seems very mathematical, could I inject an understanding of subjective value, which seems qualitative rather than quantitative? What are you advising us to do there?
Yeah, so yes, indeed, it might be a little bit of a dilemma at first glance, but if we talk about subjective value, then, well, if an entrepreneur seeks to undertake an investment, then subjective value is most important for him, right? It's about, well, how does the entrepreneur subjectively value that investment? And thus, he should not fall for the fallacy of so-called market value, as suggested by neoclassical finance theory, because it is actually the assumptions of finance theory which lead to no differences between human valuations, and value and price then necessarily equate to one another, and hence it is legitimate to use the term market value, but only given the neoclassical assumptions. In reality, however, as you know, markets do not value, only individuals value, so that a single seemingly objective market value does not and cannot exist independently of any acting human, and thus the term market value does not make much sense outside of the neoclassical framework, and definitely not in reality. Rather, as the Austrian school holds, value is subjective, and as such differs both from person to person and as time passes for the very same human being. So it is important to note that there is no such thing as an objective or general guidance for investment decisions. They are not generally worthwhile or not. To take such decisions rather requires subjective considerations about ends, means available, and hence opportunity costs, imaginations of an uncertain future, which necessarily must be subjective, and the like instead. So, whether or not a specific investment should be undertaken always depends on the ends a particular entrepreneur seeks for and the means available to him or her to reach those ends. That is, alternative available investment opportunities, funding possibilities, and so on, and subjective expectations in the face of uncertainty. So, even if there might be some supporting calculations, the underlying idea of the calculations should not be that there is some kind of objective value of a firm, of an investment, of a line of production, or whatever, but rather it all comes down to the subjective ends of a particular entrepreneur. What do I want to arrive at with this action? And what are the means to reach those ends? And what do I subjectively expect from the future? Right as the future is uncertain, there is no objective or true, if you will, estimate, prediction, imagination of the future, but it must necessarily be subjective and differing from one person to another.
Yeah, I remember the controversy 10 years ago in the financial crisis about the Marktomarket rule that they talked about here. So assets were marked down, often drastically, because of that rule, which would be a very non-Austrian way of looking at assets, which would be Austrians would be thinking about the future revenue streams that were coming from those. assets and valuing them accordingly. So that was one way where the local rules of accounting diverted from sound principles very, very markedly. It caused a lot of stress at the time.
Well, yes. So I mean, here, of course, we need to also distinguish between the two spheres. So the mark-to-market rule usually applies to financial accounting, which again serves another purpose. But of course, if you look at assets in the sense of, well, do I want to buy a particular asset? Well, then of course, it is only crucial for your decision to think about what will be the revenue stream in the future. What will be the payment flows that I receive back from that investment, and what are my alternatives? So indeed, such a mark-to-market, looking at current market prices, is not a good basis for an evaluation of future performance of a particular asset or a firm in total. Yes.
You mentioned that there's a possibility of incorporating the distinction between uncertainty and risk in these economic calculations. That's a very tricky definition, but tell us how to think about it from an accounting standpoint. How can I use accounting and incorporate that different definition of risk and uncertainty?
Yeah, so I mean, the Austrians, usually referring back to Frank Knight, distinguish between uncertainty and risk, and whereas situations of risk are relatively well structured and can be calculated in terms of probability of occurrence, for instance, when placing bets at a roulette table, entrepreneurs, of course, usually act in uncertain conditions. And in contrast to risk, uncertainty does not allow to objectively calculate the probability of any potential outcome of an action, and therefore entrepreneurs should not fall for the fallacy that complex math and simple extrapolations, historical market price volatility taken as an objective risk measure or the like, can overcome the uncertainty they face. So of course, no computation, even if it takes into account big data or whatever the recent developments might be, can turn uncertainty into certainty. But of course, we can integrate uncertainty in our calculations when trying to evaluate the worthwhileness of potential future paths of action. Um, we do so by, rather than relying on pseudo certain math, entrepreneurs need to exercise their judgment and think in terms of scenarios, apply simulations, which allow to prepare transparent basis for their decision. So in the mainstream, it's often the case that, well, there's a particular volatility observable among a particular market prices, stock prices in a particular market. So we just take that volatility as a risk measure for future deviances, if you will, from an expected value. But there's so many fallacies in here, so it's not possible to simply extrapolate, and it's not possible to have one objective risk measure which is suitable for each and any action that is directed towards the future. So still, what entrepreneurs can do, I think it's not advisable if they just sit back and just say, well, let's give this one a try without any pre-planning or calculation. But of course, what they can do is to imagine what future path of action would look like and to what they might lead, and then take these different imagined scenarios and or simulate different imaginated scenarios, and then of course they can calculate the financial results if those scenarios were to come true. And then, of course, the computation itself does not provide any final guidance. Then, of course, it is eventually the entrepreneur who has the power to finally decide, who needs to apply judgment as to whether he thinks that scenario A, B, C, or whatever is most likely to occur. So there are some calculations supporting an entrepreneur and, so to speak, turning imagined scenarios into financials. But then, of course, it's the entrepreneur, him or herself, who in the end needs to evaluate and to apply judgment in the face of uncertainty to decide which path he actually or she actually wants to take.
Is that what you meant, David, when you talked about the ability of accounting or managerial calculation, I suppose, to recognize the time dependency of evaluation and action? Is it through those acts of imagination and simulation that you talked about? Is that how we incorporate time dependency and time preference?
Well, I mean, there's two things. So time dependency usually is incorporated through means of discounting. Okay, so if you have $100 today, they don't have the same value to you as $100 in 10 years from now. So we need to know if we invest a certain amount today and we expect to have certain cash inflows over the whatever period of 10, 15, 20 years or so, then each year these different payments will have different value because they occur in different periods. So the discount rate then, which is in a neoclassical setting often confused as some kind of objective measure, which is gathered from market data. But in an Austrian sense, actually this discount rate is determined by the entrepreneur's time preference. So, for instance, if you seek, or it doesn't even necessarily apply to entrepreneurs alone, but human beings in general, if you want to consume as much as you can now, if you have a very, very high a time preference, well, then what do? You probably take your equity funds and take out as many loans as you can and simply consume and pay back later. Well, if you have a very low time preference, well, then you might not consume as much, but save and invest. So, depending on what you do, whether or not you conduct certain investments and how you finance those investments, will actually change the relevant interest rate for discounting purposes, for discounting future payments. And this discount rate in a sound Austrian setting is actually a derivative, if you will, of the particular valuing subject's time preference.
Okay, understand that. And then let's think about how accounting can provide a good set of signals to the entrepreneur, David, for business health. Sometimes I'm an amateur in this, but you tend to think of accounting, especially financial accounting, as kind of a snapshot in time. But I want to know what my business health is in a dynamic kind of a way. Is it improving or is it getting worse? And am I looking at it in the right way? So, are my accounting calculations going to be a good signal of business health for me?
Well, yes, they might be. So what what an entrepreneur needs to consider is actually that accounting does not really provide one true, fair, objective picture of the firm, even though this is the stated aim of financial accounting usually. So there are some measures that can be very useful for the entrepreneur, but the entrepreneur needs to consider that accounting is not perfect and it does not show an objective, true, fair, neutral picture of the firm, but rather is the outcome of the exercisement of explicit and implicit options in applying particular rules, which follow particular norms and seek to fulfill a particular purpose. So I don't think that general guidance is useful or possible with regard to the question what business metrics provide the best picture for analyzing a firm. It actually all comes down again to what goal an entrepreneur strives for in a specific situation, which again reflects the Austrian principle of subjectivism. So, for instance, if an entrepreneur wants to sell his or her business, it might be wise to concentrate on and adjust metrics such as the earnings before interest and taxes, because, useful or not, investors oftentimes might want to negotiate about a particular multiple of the firm's EBIT prior to a sale. If a company seeks debt financing from a bank, oftentimes solvency measures such as the debt equity ratio may play an important role. I mean, naturally, it is crucial for business sustainability to be solvent, liquid, that is, being able to pay your bills when they come due, and profitable. And while various metrics of liquidity, solvency, and profitability can be useful depending on the business's circumstances, I think that in general, both the gross profit margin and the net profit margin are noteworthy. The gross profit margin basically reflects what percentage of revenue from sales is left over once the cost of goods sold are deducted. And the net margin then equates to the percentage of what remains from revenues after all expenses are deducted. And again, while it is of course both important and necessary for a business to be liquid and solvent and thus to monitor and manage its cash in and outflows, because profitability alone doesn't keep you from running out of cash and going bankrupt, I still think that profitability is crucial for long-term success. What I mean by that is, well, if you're liquid now, but unprofitable in your operations in the long run, well, this can be more harmful than being profitable and having to bridge a short-term liquidity gap. So if, as an example, think about the recent phase of cheap credit and inflated asset prices, which have allowed companies to generate cash flows from financing activities and or investment activities. So to be liquid while not necessarily being profitable in their actual operations. And there's an increasing percentage of so-called zombie firms which have been kept alive due to ever more liquidity in the market rather than their genuine profitability. And if your business runs profitable, there should, I think, in general, be chances of bridging a short-term liquidity gap one way or another, particularly in times of increasing financing options, including crowdfunding and the like, on top of more traditional lending options. If, however, your business is not profitable, then liquidity will most likely be gone sooner or later too.
Jeff Bezos at Amazon, David, I'm sure you're familiar with his sayings about running a business on free cash flow is more important than running a business on profitability. And he, I don't think he has any trouble paying his bills. So, what's your comment on his approach?
Well, I mean, referring to what I just said, I think, yes, of course, cash flow management and monitoring of cash flow is really important because there is definitely, especially when it comes to new venture creation, startup firms, one of their biggest challenges is to keep track of incoming cash, outgoing cash, because you might have sales, but if the sales are on credit, okay, they are referred to as revenue in the profit and loss statement, but if you sell on credit, you don't have a cash inflow. Okay, so you might run out of cash at some point, and even though you're profitable, you might go bankrupt quite soon. Um, well, I mean, so even though probably Amazon does not necessarily run out of cash soon, well, I mean, I don't see any big general advantages than on for concentrating on cash flow only, because the profit figure, well, might be important when, for example, determining the amount of dividends which are distributed. And so I think in general, there should be kind of a complementary view. There should be neither a sole focus on cash flow nor a sole focus on profits, because both are very crucial. But I think, well, if you run your business profitably, if the returns from sales are higher than the revenue, higher than the expenses that occur throughout your business process, well, this is a very good sign. And if then on top you manage to have liquidity at all points in time, you manage your cash, well, then this is perfectly fine to me. So I think it's not either one. I think both are very important for particular purposes, and both are very important to be monitored and managed. And so I think that Bezos might probably emphasize one and prefer one, but I think that both are crucial and have their place, I think.
One of the activities of the entrepreneur that we stress a lot at Economics for Entrepreneurs, David, is dynamic flexibility, how to achieve and manage a resource allocation style and an organizational style that is very, very responsive to changes in customer preferences and changes in the market. And you've told me in the past that there is a dynamic approach to financial accounting that's compatible with that dynamic market process. I think you actually called it dynamic accounting. Can you just summarize that first? I know you've touched on it already so far, but just explain that term dynamic accounting for us.
Yeah, sure. So if we talk about financial accounting, we need to know that there's two different approaches, basically. One that favors or emphasizes the role of the balance sheet, which is more of a Anglo-American, Anglo-Saxon view, or the other way is to emphasize the role of the profit and loss statement, which is more of a continental European um, approach. And the focusing on the balance sheet and the current measurement of assets with the latest market prices represents, like I mentioned before, a neoclassical static equilibrium concept. Emphasizing the importance of the income statement, in contrast, represents a more dynamic approach to financial accounting, which is indeed compatible with the Austrian view of both the dynamic market process and the purpose of capital accounting. So the term dynamic accounting actually stems from the German business economist Eugen Schmalenbach that I mentioned before. And with the term dynamic accounting, uh, he actually wanted to describe the key characteristic of this approach, which is to focus on the outcome, profit or loss, of entrepreneurial action in a dynamic market setting. So he argued, well, the primary purpose of accounting is not to assess statically at a certain point in time to assess the net worth of a particular company, but rather the primary purpose of accounting must be to compute the profit or loss of the dynamics of entrepreneurial action over the recent, for example, year. So profit or loss reveals how well the entrepreneur employed funds and assets available to him or her in serving customers. So dynamic accounting wants to capture this information rather than presenting a static picture of a firm's net worth.
And so how do I capture that in reporting? You said over the last year as an example, but maybe my market is even more dynamic and consumer preferences are changing at a more rapid rate and I'm making adjustments. Can I look at it on shorter time periods? Is that a way to be more dynamic?
Well, I mean, it depends usually on the type of firm, on its legal form, on its size, as to whether or not companies provide financial statements once a year or maybe even quarterly. And of course, it is possible internally for yourself to prepare statements on a more regular basis rather than 1 year. But the usual requirement for financial reporting would be to report on a period of usually 1 year. Um, but the idea is not that, well, with all the dynamics occurring and developing throughout 1 year, still at the end of this 1 year, the idea of the income statement is to show, well, how has the entrepreneur done in this dynamic market setting? Of course, it might be that you say, well, we calculated a particular profit, which might not be very sustainable because the market is changing so quickly. But then, of course, financial accounting, due to its primary purpose, and this is also the primary purpose in the Austrian sense, to assess and report on the success or failure of the recent action of the entrepreneur, then of course there's some kind of barrier or dilemma if you wish to incorporate a huge degree of dynamics and flexibility, which might be seen in a very rapid change in the near future. So again, the dynamic idea of accounting here comes into play because it emphasizes the role of the income statement, which then actually leads to different kind of definitions of assets and liabilities and different ways to presenting them in the balance sheet. So basically, again, you can either say, well, the financial statements shall primarily provide me with a static picture of what is the company's net worth as of 31st of December, for instance. Whereas the other approach is, well, if we emphasize the income statement, then the balance sheet doesn't matter much. Actually, Eugen Schmalenbach called the balance sheet as merely a firm's power reservoir, which contains only those items that have not yet found its way into the income statement, but will do so in the future. So emphasizing the role of the income statement emphasizes the purpose of financial accounting to determine profit or loss of entrepreneurial action, which is dynamic in nature, rather than assessing a static picture of a company's net worth.
Well, just as a thought experiment, David, I was looking at a business the other day, a candy business, and it's tremendously seasonally variable. So you sell a lot of candy at Christmas and at Easter and at Halloween and Valentine's Day and a couple of other seasonal occasions. And then in between those, you've got flat business. You might be even taking returns from seasonally specific product that didn't sell. And so the profit and loss of the business has these huge peaks and valleys during the year, and then you look at the end of the year and you look at how you did. Should a business like that be thinking about the profit and loss of each of the seasons, or the profit and loss averaged over the year? Is there a way of looking at both of those, or do you average it out? What's the right way to guide the entrepreneur?
Well, I mean, if we talk about financial reporting, financial accounting, then indeed you would contain in the income statement the actions throughout the entire year. So you would have all the sales, you would have all the cost of goods sold and depreciations of your machine and so on for one year usually. However, of course, especially in more internal considerations, managerial accounting wise, you might have breakdowns of those aggregated numbers into, for example, segments, or you might make seasons out of it, right? So you might say, well, we sell our candy in, I don't know, North America, we sell it in Europe, we sell it in Asia. These might be different segments. Or you might say, well, I sell this kind of candy, which is one segment, and another kind of candy, which is another segment. And then, of course, you might also break down your operations into seasons. And then you might try to figure out, well, what can I do in seasons where there's high demand for candy to best meet customer demand? How can I manage to not have a lot of returns? What can I do in the seasons where there's not much demand for candy, like in I don't know, in the summer when it's really hot outside, maybe you don't consume as much chocolate. You might want to think about, well, is there any way I can actually make use of these seasons too? For example, through introducing ice cream or the like. So usually in financial reporting, simply because it's legally required that way, you will have an overview over the entire year, and you will not show particular seasons separately in the income statement. What you can do, though, oftentimes financial statements are accompanied by so-called notes, where you provide explanations, if you wish, and if it's legally required. You provide explanations, for example, on particularly aggregated positions in the balance sheet or the profit and loss statement. So you might say, well, our revenues have amount X, but they mostly came from 70% of that came from the Christmas season, for example. So you might provide additional information on the aggregated figures that you present in the financial statements themselves. And then again, on top of this, for internal considerations, like I said in the very beginning, they are usually not regulated, so you can do whatever you think fits your purpose best. And then, of course, you can break down the numbers into different seasons, and you might see, well, what product contributes how much to the actual success. Maybe we should get rid of this line, maybe this product. Maybe we should introduce another product which might help to create more value to the customer, and thereby to have more success for the business in the seasons where we don't have much sales yet.
That's a good example, I think, of the two poles that you've talked about: knowing and following the local rules when you're doing financial accounting, but also using the tool that provides the best and most transparent support for your entrepreneurial decisions when you're talking more about managerial accounting. So that's a good example. Let's close, David, on the higher level assessment of accounting. You've mentioned Mises, and he called accounting the guiding star of action under the social system of division of labor, a precious intellectual tool of action, fundamental to civilization. And you quoted Goethe, one of the finest inventions of the human mind, he called accounting, or double entry bookkeeping, I guess, specifically. So let's have you conclude by elucidating on why accounting is elevated to such an important civilizational position? How do you think about that?
Well, I think that Mises, probably clearer than anyone before him, emphasized that what he labeled economic calculation is actually the necessary precondition for economizing decisions on resource allocation and production in a division of labor or market economy, and that the absence of proper economic calculation will ultimately lead to chaos, as he famously pointed out in his central argument in The Unmasking of Socialism. Right, economic calculation in the socialist commonwealth was the famous, at least the English title of his famous article, Unmasking Socialism, due to the failure of having sound economic calculation. So he rightly argued that autarkic individuals and even simple communities, such as a small family or the like, they largely get along without economic calculation. However, the development of civilization and the progress toward a complex monetary market economy with a vast division of labor, I think would have been impossible without the tools of economic calculation. So the evolution from a self-contained economy and barter all the way to a complex monetary market economy has brought about levels of wealth and standards of living probably unimaginable initially, thanks to economic calculation as one of its necessary preconditions. So without the advancement of economic calculation, which, among other things, directs goods of higher order to their most valuable use, the development of human mankind as it has been would have been unattainable. So, consequently, actually, both Schmalenbach and Mises considered accounting the compass of the man embarking upon production, and this compass has directed mankind to ever greater prosperity. And yet, accounting is often caricatured as a boring, dry, maybe even dispensable subject by some. However, quite the contrary. It is actually one of the most important mainstays of mankind's astonishing progress, and as such, I think unquestionably deserves Mises's high praise.
Well, thank you. That's a fine place to conclude our discussion of accounting for today. So, David, thank you so much for sharing your knowledge and your expertise and your perspective. I think you've given us a new outlook on accounting as a purposive tool for the entrepreneur and new ways to think about it. And I think challenges a little bit to make sure we use it in the best way we possibly can. So thank you very much.
Well, my pleasure, Hunter. Anytime.
Economics for Entrepreneurs is a production of the Mises Institute. To explore more content like this, visit Mises.org. That's MISES.org. For more from Hunter Hastings, check out hunterhastings.com.